Welcome everyone to part 7, Price-Based Signals of the 10-part Executive Training Series. I am Frank Ochoa, aka Pivot Boss. I'm very excited to bring you this new topic here, Price-Based Signals, which is actually based off of the price-based signals that I taught in my book, Secrets of a Pivot Boss. For those of you that are not familiar with Secrets of a Pivot Boss, I wrote the book back in 2010, or published a book in 2010, and since then it's received amazing feedback and testimonials from traders all over the world. It's really warmed my heart, humbled me significantly. I can't believe that something that I wrote that was kind of near and dear to me for 18 months while I nursed that book and tried to put the best foot forward for that book that I possibly could, provide as much amazing content that I could into that book. It's quite humbling to see it all pay off and see so many people, so many traders gravitate toward the concepts that I taught in the book. Really and truly, a lot of the concepts that I taught in the book are concepts that will continue to last throughout the time because they're based off of price and value, volume, those types of concepts. And when you do base your analysis, you base your trading off of those concepts, you will always have a leg up in the market because you know what to look for. And that's what this entire 10-part executive training series is about. It's about knowing how to analyze the market via price, volume, and value in order to identify the best opportunities you can. And with price-based signals, these are signals that are based purely on price. They help you identify key buying and selling opportunities, and when properly qualified, they can help you highlight great trading opportunities in any market, in any time frame. So without further ado, let's go ahead and get started with part 7, price-based signals. All right, I made you a couple of cheat sheets here for price-based signals. We have 2 cheat sheets. The first one here is all about introducing the price-based setups. Again, Secrets of a Pivot Boss. If you haven't already purchased the book, I would highly recommend it, especially from PivotBoss, since it's going to be way cheaper than what you see anywhere else online. So I would highly recommend it because it goes so much in lockstep with what we teach here, and those concepts continue to hold value and hold weight as we move forward. So that's always great to see. And one of the sections in the book is actually part 2, where I talk about these setups. And these price-based setups are just that. They're based purely on price, and they help you identify trade opportunities in any time frame, in any market. And really and truly, these are very simple price-based setups. I mean, basically the very first one is nothing more than a wick reversal setup. It's a candlestick that has basically a high appeal when you're looking at it on a chart because you can see this tail from a mile away when it punctuates a high or a low. When you see a tail form at a key rejection area, it really helps to bring that opportunity to the forefront and tell you that there's something there. This opportunity, the wick reversal setup, is designed to help you identify those areas where rejection is being seen in the market, in the auction. And when it all comes down to it, remember, the market is all about identifying those areas of rejection and trading price at those areas and returning price to value. So that's what many of these signals are designed to do. These setups are designed to help you identify rejection in the charts. And this wick reversal setup, what's really special about the way I do it is more about identifying those key parameters that make sense in terms of identifying the right types of wicks, because this tail right here needs to be a certain size when you compare it to the size of the body. You know, and having a 2-to-1 ratio is the standard candlestick size, I guess, requirements for a wick reversal type of candlestick. So if you're going according to traditionalists like Steve Nissen, for example, who wrote Japanese Candlestick Patterns, a great book, by the way, that I read a long time ago. But all they want is a 2-to-1 ratio here, where this tail is 2 times longer than the body. But for me, I'm usually looking at 3-to-1 or more, 3.5 to 1, for example. That tells you that this candle, this tail has a much longer tail compared to the body. That means the rejection was more pronounced. Additionally, where price closes in relation to the overall range of that candlestick is very important. So price closing here, very close to the high, is important and tells you that this rejection was more pronounced as well. If price had closed somewhere down here and this was, a bearish body right here, this close here wouldn't be as bullish as a close up here. So this type of measuring here allows you to really home in on that criteria that makes for a more successful candlestick pattern. Additionally, the overall size of the range. The overall size of the range takes you from high to low, right? This is the high, this is the low. Having this size of the range and then comparing it to the average size in over the last 50 bars, for example, if this range is, say, 10% or 20% larger than average, that also tells you that you have a more pronounced candlestick. So when we're dealing with the anatomy of any of these candlestick patterns, all of these nuances make a lot of sense. You have to know what to look for. And that's what we'll be talking about when we're looking at some of these patterns now. So the wick reversal candlestick, very important. This is going to be one that helps us identify rejections at support or at pullback points, like the pivot range in an uptrending market, those types of things. You have your bearish and your bullish instance. The extreme reversal setup is perhaps my favorite of all time, and I've made no bones about that at all. I mean, this one is perhaps my favorite one of all time, my biggest money maker at the time, my first huge money maker, and this one was the one that initially got me into all those moves in the energy sector when the things were rallying significantly in the mid-2000s. And it's all about the rubber band trade for the extreme reversal. And it basically means that, if you're trading, all of a sudden you see a huge move one way or another, price can become overextended at that point, and then you could see a return all the way back to where the initial impulse move began. And that is an extreme reversal, when you have a huge overextended candle and then an opposing candle that starts heading in the opposite direction. This right here is kind of a rubber band trade that usually tells you that you're going to snap back in the other direction. So identifying these types of extreme reversals can be extremely fruitful in the charts, especially the higher time frame you go up, the better for any of these patterns. But you can find them in any time frame, from 1 minute charts all the way up to monthly bar charts. And that's why these patterns become so powerful in allowing traders to use them to trade intraday time frames, swing trading time frames, or use them for retirement accounts and look for higher time frame investments. The outside reversal candlestick is more about seeing rejection. So the outside reversal candlestick helps you identify failed rejection one way or another, failed range expansion. So if this high right here, price was attempting to push beyond that high, and then it failed to hold above that high, and you see a rejection all the way across the range until it closes below that candle's low. That's an outside reversal, the way I define it. So basically I'm saying you have a high here, and that's higher than the previous high, and then you have a close down here, and it's lower than the previous close. That's a bearish outside reversal setup where prices attempted to get higher. There was a failed range expansion beyond that zone. So in that case, the market options lower against the previous range and through it, and that leads to a continuation. So that is going to be an important one to find out as well in the charts. And the last one is just the basic doji reversal setup, and this one is one that helps you identify exhaustion points, or it helps reveal indecision in a chart. So typically speaking, when prices are auctioning higher, and then all of a sudden you have this little doji bar that comes into effect, and then price closes against that doji in the upcoming period of time, well, now this becomes a very important area to defend for a continuation lower, because that pattern is one that has high odds for reversal. especially when you are able to qualify it properly at the right spots in a chart. So now that we kind of have an understanding of what these price-based signals look like, we're going to give you some guidelines for how to use them properly, how to use them the best way so that you get the best chances for a good result. Now here you see that price-based setups are designed to identify market tendencies that reveal certain behaviors and psychologies that, when paired with overvalued and undervalued areas, can prove to be quite powerful. That is extremely important. So that's why these price-based setups work, because they're just basic candlestick patterns. It's not a big deal, right? Well, depending upon where they form, how they form, if you're able to qualify them at the proper over or undervalued areas or areas of rejection, pullback areas, those types of things, then you have a very good basis for what the underlying psychology of that price pattern is doing. And then from there, you can have a very good idea of where price is likely headed. So that's what makes these price-based patterns so important, is they're based off of the inherent psychology of the market at that time. They reveal the market tendencies and behavior that's going on at the market at that time. And when certain tendencies are occurring, you have an idea of what could happen in the upcoming period of time. So you have to know that. And again, here, this is a quick quote from the book here. And I just say, the best traders are those that can quickly discern the pattern of the market and successfully deploy their capital at the best price. And that's from my book, Secrets of a Pivot Boss. And it holds true. It's those traders that can quickly and easily identify what's happening in the market right now and then act upon that information are the ones that are going to capitalize on that move. That's what this whole thing is about. That's what the PivotBoss Premium Trading Room is all about. It's giving you that running commentary and dialogue and analysis of what's going on in the charts so you can quickly identify what's happening in the chart, get in, get out, and execute that trade. So that's what this is all about in terms of the price-based signals. Identify those signals, qualify them properly, and then act accordingly. These things are going to be popping up opportunities to your forefront very, very quickly because they're easy to see on the charts. And when you're able to see these signals pop up at the right spot, you'll be confident to be able to pull the trigger at that area. So here's a couple of quick notes. First, obviously, the price-based setups reveal a market psychology, and that's a driving factor behind every price move. Fear, greed, and uncertainty, right? And that's what we already know about these price-based setups. They also reveal when a market is experiencing rejection or exhaustion of a price move. So again, that's very important. That tells you that there's a potential turning point coming in the charts. When properly qualified, price-based setups can offer high probability opportunities in all time frames and instruments. And again, that's really the good thing, the advantage to using any price or volume-based approach, because they are scalable to all time frames. So these signals can be used for anyone, whether you're a scalper or an investor. And lastly, these price-based setups are perfect for creating market scans, signals, fully automated trading systems. And that's really what we've done with them already. We've created every single one of these based off of this basic price pattern. I have scans, I have signals, automated systems. I got everything based off of these. And you can too. So that's what's fantastic about having this form of analysis at your disposal. You're able to just have the market bring opportunities to you using scans. And from there, you can just pick off the best opportunities. There's a couple of things I want to show you right here. And number one is be consistent. So every time you see a signal here and you're going to enter that signal or enter that trade, you have to be consistent in the way you execute that trade. You have to have a predefined entry and exit technique toolbox that you can refer to in order to execute this position in a consistent manner every time, because consistency of execution matters. Remember, it's all about process. When it comes to trading, it's all about execution of process. You have to go the right way. You have to be able to execute that entry. Say, for example, your primary entry is going to be a retest entry. I'm going to put a limit here. When it retests the area, I'm going to get in. Well, when it gets in, you need to be able to execute immediately and put in and automatically trigger your trade management that follows. Well, say your retest doesn't trigger there at that limit that you specified, and instead price leaves you behind. Well, now you can execute a different entry approach later on based on that new information. That's part two of your plan, which is, okay, now we'll do a retest of the range expansion and get in at that point instead, or whatever the case may be. But for you, you have to have that predefined set of entry and exit techniques that you can refer to so that you can have consistency when you're executing these trades. Going willy-nilly and executing one way and then sometimes managing it this way and sometimes managing it that way, it doesn't provide the consistency required to be a consistent trader. And when you document, it makes it very difficult when you trade journal to know what's working if you don't do a consistent approach or if you don't execute following a consistent plan. So that's important. You also have right here, be patient. This is very, very, very important. Just because a signal fires does not mean it should be traded. That is very, very important. And I need to put like some little spotlights and beacons right here and little stars, because this is very, very important. Just because a signal fires does not mean it should be traded. Each signal is merely a prospective opportunity that should be further scrutinized. So it's just an opportunity. And that's why, I stayed away from signals for so long over the past 5 or 6 years, because I like to trade signals because I know what's going into the signal. I've created the signal. But when it comes to me teaching others the signals, I don't want you to trade them blindly, because I don't trade them blindly. They're not meant to be traded blindly. Sometimes you can create algorithms and those things, but you have to really qualify those events. So I'm not trading every one of these, exhaustion type signals every single time. I have to further qualify it. But if I have an algorithm that's trading it, it's qualifying it within that strategy already, so that I don't have to do the guesswork. But I will teach you what those things do, how to qualify it. And right here is exactly that. This is tips to engaging price-based setups. So right here you have number one, trade only smooth moving charts. That's huge, because if you trade a chart that is trading smooth and nicely, chances are it's going to continue to trade smooth and nicely. If you have a chart that's trading erratically to the left, if you're looking at that signal and you look to the left of the chart and it's trading erratically, then it's likely going to continue to trade erratic in the future. So you want to trade only those smooth moving charts. Number two, trade signals at clearly established areas of rejection. So it needs to be an area that you would normally execute a trade. Just because a signal fires in the middle of a trading range, that doesn't mean it's a good signal. You have to wait until that signal is fired at an extreme, at an area of over or undervalued price zones, or at an area where you're seeing rejection on the profile. Those types of confluence zones are what's going to help this signal work out. Additionally, trade signals in the direction of an established trend. So if prices are trending up like this, you want to buy signals here at the pullback zones. Buy signals, buy signals, buy signals in an uptrending market. Sometimes what you'll see is beautiful buy signals that form here, but then you'll see a sell signal somewhere in here where we're trending up. So ignore the sell signal right now. It's very simple. Trade signals at the extreme of a significant move. So price-based setups work best after significant exhaustion has been seen, typically after a prolonged or sudden move. So sometimes price will shoot up big time like that, and when it does, it finds a high, and then it usually smacks back to the midpoint, if not all the way against the range. So when you see that extreme move up here, that might be an area, if there's a signal there, to take this thing back, because you're likely going to see a swift return as well. You also have here trade signals that occur at confluent zones. So signals with additional confirmation offer higher probability odds of success. Like say if you have pivot-based confirmation, value-based, volume-based, confluent zones, any of those. Any form of confluence that we use can help to confirm these signals. And lastly, avoid signals in the middle of congestion. Signals that occur within price congestions tend to exhibit whipsaws and false moves. Remember, signals are meant to be traded at areas of rejection, not acceptance. So when you are in the middle of a congestion here and you're trading sideways like this, and you get a signal here, signal here, signal there, signal here, none of this matters because those signals don't work in that zone because, remember, the market is trading within a balanced range and wants to stay there. This is a balanced range. It wants to stay there, so there's no edges. Up here, this is where you can attack sell signals, and down here is where you can attack buy signals at the edges of the range. This is the rejection zones, right? Overvalued, undervalued. So that's why all those words are in there. You can't trade a signal in the middle of chop because it's not going to work. All right, so those are some of the guidelines here for trading price-based signals. Again, these two cheat sheets here, put them next to your computer, your trading machine, pop them out when you need to. These are going to help put you on the right side of the market when you're using these signals. So let's drop down into Thinkorswim. All right, here's Thinkorswim right now. And you can see this is a basic chart right here of the NQ. And the NQ, you see these little white signals right here. See a little down arrow, little up arrow, little up arrow, up arrow, up arrow, up. I missed a down here. Here's a down, here's a down, here's a down, and here's an up. All those arrows, those are all coming from these four signals. These are the signals. So we have our extreme reversal right here. We have our wick reversal right here, doji reversal there, and outside reversal there. Each of those are right there, and these are the ones we just talked about in the presentation. And so they're all in here, and I don't know which one's which. I just have to look at them, right? So this one is an outside because here it is. You got a low below this low and a close above that high. That's an outside reversal right there, and that's a long signal. This one right here appears to be a doji type of signal. I believe that's a doji from here to here, that little kind of indecision bar, and then price closed above it. Over here, this is obviously a wick reversal candlestick, very nice and long and big there. This one is another extreme, an outside reversal, high above the high, close above the low, close below the low. So each of these signals are very important, but obviously when you're looking at this and you're saying, okay, here's an uptrending market, typically speaking, you want to see pullbacks have the signal and then you take it long. If you're at the top of a move and you get a signal like this, this isn't where you want to buy. I'm never going to take a long signal if it's forming at the high. So if you're looking at this in real time, when it happens, this being real time right here. So if this is in real time, let's go one more here. And we're saying, oh, look, here's a long signal. I'm not going to ask you to buy that. I'm not going to ask myself to buy that. Why would you buy at the highest high here after this big move? Our goal is to buy pullbacks in an uptrending market, pullbacks. And right now, this thing is forming at recent resistance. That's not a spot to buy. And I actually said that before to whoever I was talking to at the time, whichever audience I was talking to. And, you know, obviously that ended up being the high up there where it just kind of fell apart and held. So, you know, those simple rules can help keep you on the right side of a chart. If the market is trending one way or another, let's go to crude oil here. Crude oil has been a trender. Here's a trending crude oil. Let's put some monthly pivots on it. So here are the monthly pivots. Ideally, the idea is if prices are trending lower, like they are here, you want to sell pullbacks to the pivot range, right? Pullbacks to the pivot range. Well, here's a sell signal that occurs after price is holding here. This is on a low, but it's at a point where expansions are likely to occur. And that's what happened. Likely expansion did turn into expansion, and then we saw it hold and continue lower. But in this case, when you're trending downward, this sell signal trending downward is a good call. But when you look over here to the side, look at this right here. This is a trading range. This is a trading range. So all of the signals that come in here, that's not a good signal. So this one, not a good signal. It's in the middle of a congestion. This one, not a good signal. It's in the middle of a congestion. This one, it's at the bottom of the range, not as bad, but you know, still, it's in the cluster. This one was okay because that was after the initial impulse move and price pushes back. This one's good. But everything else after that, not as good. And that just kind of goes to confirm you want to avoid trading signals that occur at the center of a range, right? So avoid signals in the middle of a congestion. That's a congestion. Avoid those signals. Ideally, you want signals trending in one direction or another. So right here you see price trending down. So it's better to sell the signals in a downtrending market than to buy the signals in a downtrending market. So if you see this downtrend pulling off and you see this pop in and this pop in, you know, that's not going to help right there unless this is a significant area of rejection. But it can't be because we just saw expansion out of this range. So when you're trending down, focus on the sell signals, avoid the buys. When you're trending up, focus on the buy signals and avoid the sells. A couple of key things, right? Additionally, whenever you're taking some of these signals, it can be very simple just to find a midpoint of the bar and then take it long for an entry. But we're going to talk about entry opportunities here in part 9 of the executive training series. So basically speaking, this is these signals show up beautifully in any time frame. So here's a daily chart for the ES, and you can see here higher low right there, and then this signal forms on an outside, and then the huge move that ensues. Here's the pullback after this rally, and the pullback has an outside bar, and boom, it continues higher, right? And then you see a failed expansion here, you see a lower high here and a lower low, and then you see a pullback with a lower high. This actually is a good opportunity, but it is at the center of a range. So, you know, you just have to watch out. There was enough here to be able to get in that day, scale out at some point and get clean, but you have to be able to see what's in the middle of the range and what's going to happen. This one could have been decent. It worked out for a one-day move and actually 1.5-day moves, but eventually it came back up to it, and then that was the expansion. And then since then, we've seen sell signals in the down move. So again, when you adhere to some of the basic rules for using these signals, it's all about qualifying things properly. And you know, as we look at some of these charts, like let's look at Apple. Apple had news yesterday. It got a big gap down. We were looking for price to hold above 98.19, and the failure to do so led to a big move down. That's huge right there. We were looking for that zone to hold, but again, you don't want to trade ahead of earnings because these things tend to happen. And that's why I put these little phones and things on the charts, because you can see when that report's coming up and I can hold off. I'm not somebody that's going to trade ahead of those earnings like that. But look, there was a signal right there. So maybe that should be number 7 on our tips to engaging price-based signals is don't take a signal on the same day as an earnings report, right? Because here was a nice long signal that came in off of a zone that we thought could be defended, and here's the report, and all of a sudden you see a gap down. So never trade ahead of a report, and I guess a signal would be the same thing. I wouldn't have been trying to buy long that signal ahead of the report. I'd be waiting. Okay, so if I click on this one up here, this one looks like a doji. So if you click on that, it'll pop up the doji reversal. And this is what it looks like inside. So the doji reversal here, you have percentage, which is 0.1. That gives you 10% that the body can be. So I'm saying that the body can be at least 10% big compared to the average, to the size of the range of the bar. Instead of, you know, the doji has to open and close at the same line. That's kind of hard for stocks. It's kind of hard at times to get that. There's too much rigidity in there. And when you're talking about rigid constraints like that, it doesn't usually do well when it comes to raw signals. So I put a 10% look, and then you have 50 bars back that it's using to identify whether the bar multiplier is right. The bar multiplier for me is saying the doji bar needs to be 65% of average range or lower. So you know I like to use that 65% of average range to identify compression. Well, ideally doji bars are kind of small indecision bars. So this tells me it needs to be 65% of average range. And average range I'm calculating over the last 50 bars back. Additionally, you can see in order for me to get the little signals there, I'm saying up arrow at low for the buy, and it's a Boolean yes or no. Width is a 4, style is here, the color is white. So then if I click on sell, it'll say down arrow at high. So here, down arrow at high. So that's how it says it. So I broke it off between buy and sell, and that's how I was able to write that code to get that signal the way it is. So that's that one. If you look at one like this one, this is the outside reversal code there, or dialog box. So here's the outside reversal dialog box. This one is probably the simplest one we have, and it's just these two parameters. Bar multiplier is 1.25. So that tells you right there that the outside reversal signal bar needs to be 25% greater than the average size of the bars over the last 50 periods. So over the last 50 periods, say you've been averaging 1 point of range over the last 50 periods. That means that the signal bar right now needs to be at least 1.25 points of range or greater to be able to be considered a signal. So again, I do the size of the overall bars because that tells you there's significant range there, right? That could be an event. So let's take a look now at another one. So that's doji and outside. Now we can look at something like this one. This one is going to be your extreme reversal. So here are the dialog properties for the extreme reversal. These are the three. The body size, that's telling you that the body from high to low, from open to close, the body of the extreme bar needs to be 75% filled. It needs to be 75% body. And then, so basically, if we're looking at, this would be the first candlestick needs to be 75% body in the extreme reversal. So the extreme bar needs to be 75% filled. And then over the last 50 bars, you're going to get the average range, and the range of that signal bar needs to be double the average. So it's saying it needs to be at least 2 times greater than the average bar. So when you come over here now, and you look more closely at this extreme reversal, and it's right here. Okay, so we have a couple of extreme reversals in this chart. The first one we were looking at right now is this one. So this bar is 2 times greater than the average bar size over the last 50 periods. Okay, so that's the one. And the body from this open to this close is at least 75% filled compared to the wicks. That's important. So then you see the bull signal come in on the second bar, and you see a little modest move up. Over here you see a bigger one where, again, this range is 2 times greater than the average range going backward. You see a big stab event downward into the 75% PivotBoss expansion level. Then you see the counter bar here, and then you see the move up. That is textbook. That is textbook. And then you see an extreme reversal here where we see a big push up, counter bar here, and then you see the fade down. That is textbook. So right there, you can take a picture. That's a beautiful, perfect extreme reversal right here. This is the type of move you're supposed to see. That's a 1, 2, 3, 4, 5, 6 day push up, and then you see it eventually fade. Take what the market gives you. Scale out along the way. Get into that trade however you can, and then look to scale out along the way so that if this event should happen, you're not going to get scathed. You're actually in the market. But again, you want to be out against that report anyways. Because here's the report, I would be out. So if you get this move and you get it clean, I'd be out on this day if there was any position left. Who knows if I was still holding on? But you know, you scale appropriately. You got to make sure you're out before this day hits, because that's when the call comes out. And the last one is going to be a wick reversal candlestick pattern. Here's a basic one right here. So if I double click that one, it'll pop it up, bring it up over here, and there it is. Basically, you can see there are 4 parameters on this one. The first one is 3 1/4. Remember, the wick multiplier is 3 1/4, so that means here's the body. The size of this body right here will determine how big that wick needs to be for us to go. So if this body's, you know, 1 point, then this tail needs to be at least 3 1/4 points. It's a 3 1/4 to 1 ratio. So that's the ratio we're looking for, is a big tail that's 3 1/4 times larger than this body. Additionally, the close percentage, very important percentage there. So if you have this this wick right here, this would be the open, this would be the close, this would be the high, and this would be the low. So this close from this level to this high, what's the percentage close of the overall candle? So I'm allowing at least 35%. So that means a third. So if you cut this thing into thirds, the overall range from here to here, cut it into thirds, it looks something like this, right? That's the first third, second third. So it needs to close somewhere at least here or above to be a good signal. And closing this too high, like putting it in a 10% close percentage, would be really good. You're going to get some great signals there, but you're also going to weed out a lot of signals that turn out great because they didn't meet that percentage. Also, the bar multiplier, this wick needs to be 10% greater than the average bar size over the last 50 periods, 10% larger. So basically, those are the parameters for each of the those are the parameters for each of the signals in toss. What I love about this one right here is that this signal, that's the wick reversal, it formed right where you need it to form. Here's an uptrending market. You see values higher. So when price pulls back to the pivot range, that's where you want to be looking to buy. Well, we got a rejection off that level, and it also happened off of the previous close. So that makes for a very solid combination, and you can see that that ended up being the low price as price continued to push higher. Major rally from here all the way up to here based off of one well-qualified wick reversal signal. Now, since we're moving up, look at this guy come in short. I'm not worried about that one if we're moving up, right? And then you don't want to trade this one because it's on the high. Why trade it way up here? We're down here buying it. So out of this move, you got 3 signals. 2 of them can be avoided, right? This one did make money, but I'm just saying you want to be able to place these signals at the right spots. Uptrending market, you want buy signals here. Downtrending market, you want sell signals here, right? If we're in a range market, no signals in the middle. You want them on the edges of the range, or after the expansion. Because if you are coming into a trade here where you have this kind of accumulation going on, avoid those signals. And then if you see price pop up, that's phenomenal, because the next pullback, if that has a signal right there, that's a spot right there that's well confirmed for a shot at a markup. So these are very powerful. They can be engaged in so many different ways, in so many time frames. This is just a daily time frame. I mean, we can drop down into a 60-minute chart and then start to look at all kinds of amazing moves here based off of these 60-minute signals. I mean, you know, this is just phenomenal, the way that these signals can play out in a given time frame. But again, you have to be able to qualify them properly. And that's what we'll be doing in the PivotBoss trading room. We're going to begin using these in our scans. So I'm going to come to the premium trading room every morning, and with a list of stocks from our scans that we could be looking at. I'll give you the rundown of which ones are on the watch list, and then from there we can engage the opportunities. All right, so that's how we're going to be using our price-based signals in the PivotBoss Premium Trading Room. You'll be able to use these signals right there alongside me if you're using TOS. I'm also, I have many signals coded up and more to do for Market Delta and other platforms, but at least we have the TOS ones right now, and those allow us to scan for opportunities on a wider list of stocks here and bring back highly selected opportunities that we can then use as a prospecting list to find trade opportunities down the road. So we're going to be using these much more now and using them to confirm at our key levels. And again, these are signals that you can use in any time frame on any instrument. They're fantastic in any time frame. So when you're using 60-minute signals, or you're using 4-hour signals, if you're using 15-minute signals, you're going to get fantastic results if you're able to qualify them at the right spots. So basically, if you're looking at areas to buy or sell, and then you see a signal develop at that zone, you're getting some additional confirmation that that trade could pull out very nicely in your favorite direction. All right, so that concludes part 7, price-based signals of the 10-part executive training series. I want to say thank you very much for attending this presentation, and I look forward to executing these techniques with you soon. All right, take care everyone, and I'll see you soon.